Hello, welcome to MzansiOz Diary. My name is Connie. If you're new here, you're very much welcome. So today we're talking about the implication of the tariffs on this bond market. So the bond market, these tariffs that tit for tat tariff that initiated by America towards the world, and then with temporary post, and then the one for China continue up to where we are now, which is the US, the tariff on any Chinese import, it's 145%. The counter tariff that China imposed on any US imports into China is 125%. So these tariffs have a serious implication on US bond markets. And we're going to talk about that, the bond market implication. So the investors will drop the confidence. Like I said, investors and businesses prefer to know things. They don't like uncertainty. So the confidence, definitely this one has had a significant impact on investor confidence. And so this one, you might see a bond yield rising as a result of this. So because these tariffs have raised the economic uncertainty, especially around the inflation, growth, and trade stability. So when the investors when they fear that there's going to be a higher inflation or fiscal instability, they usually demand a higher return to buy the US government bonds. So because they demand a higher, return on those bonds, to buy the bonds, to buy the debt that America has. So then that will cause the bond prices to fall and the yields to rise. So the bond prices and the yields, they have inverse relationship. When one rises, the other one falls. So they don't go together. So they have an inverse relationship. So when the bond price fall, the yields to rise. So this, you see that in the chart being inversely to the bond prices. It would be a problem when we have yields rising, like that means the return on investment. So rising yields actually equal higher borrowing cost for the US government and also for consumers. They have to pay high amount of interest for the government debt, and that also will impact debt on everything, debt on credit card, debt on house, home loan, everything that is, any debt, because US is a debt economy. So that will actually really significantly cost the US government, and that is not sustainable over a long term. So another thing that you also have to pay attention to this when we talk about this bond market. So dumping of US treasuries, especially by China, also is very problematic. But we know that the result of the US bond problem that led to Donald Trump posing these tariffs to the rest of the world and keeping on with China was because of the bonds. Was it because of the sellout of the bond not by China, by Japan? Japan is the biggest single holder of US bond, but they sold their bonds when this stuff was going on. Also, China holds about 800 billion US dollars in treasury, US treasury debt. When you talk about treasury debt, we say bonds, it's the same thing. It's a debt, America's debt. So in a trade war, China could also reduce purchasing of any US debt. They can even sell to make political points, but we know that the drop in the last couple of days was not China, it was due to Japan. So it's not China that sold those debt, it was Japan. Okay, So if China offloads treasuries, it actually will increase the supply to the market, like we were talking about supply and demand. So, when you increase supply of something, you're not going to see any increase in that price, right? So you all tune in to me talking about this stuff, supply and demand, when I was talking about a property, Australia's property. So if we actually, yeah, if they offload these treasuries, so they're increasing supply of it into the treasury, the bond supply, increasing the supply of the bond will lead to actually pushing down prices. So that inversely, when you expand the supply of something, the price will go down. You don't see a wage going up, as we spoke about last time. And we also, what will happen, because the yields and the bond, they're inversely proportional to each other. They've got an inverse relationship. That means we downward pressure on the bonds and we get the yields with return on investment to shoot up. Okay, so that's not sustainable for a US. Again, we're still going to have a high borrowing cost for everyone, the government and the consumers, all Americans. Cheap debt will no longer be available for all of you. That's your liberation day for you Americans. That'll be, yeah. So this also could have a very significant implication globally as well in the global bond market. And yeah, it also going to continue to increase that US trillion plus dollar deficit even more. So it makes debt not really sustainable. It's not even sustainable right now, the US debt, but that's for another video. But we'll just keep that debt really. Yeah, they're probably going to be one of those countries that default on their debt. If this were to happen, there'll be like other countries that have been into this path before. Okay, so when you have a higher inflation now, it also makes bond less attractive. When we have a high inflation, everybody's paying more, even the government on the debt, the consumer on the debt. Then the inflation makes it even less for bonds, the government bonds, be less attractive. Okay, so tariffs equals to high import prices. We talked about that. It's 1-to-1. The fire is 1-to-1. Give 125% tariff, you get price rise by that percentage. Okay, and then that leads to high inflation. So they're going to see a high inflation in America, and then so the bonds, they pay a fixed interest, right? So if inflation rises, the real return on a bond falls. They fall. So then what will then happen is that the investors may move to gold, which what we're seeing now, the price of gold is going up, to stocks or inflation protected assets like your tips. That is another options, or also to go to other, cryptocurrency and other stuff to move away from this. So this then leads to this lower demand on bonds. So meaning that the price drops of that bonds. But then because the price is dropping of the bonds, and I told you that the relationship between the bonds and the yields are inversely to one another, and then that is the yields, the interest the government has to pay on that debt, and then the US may struggle to fund that debt very cheaply. That debt may not be cheap. Any debt for the government and the consumer not going to be cheap anymore. Okay. So when this happens, you can have that rating agency concerns. I don't know if they will have some concerns because, as we know, we've looked at the things right in the global sphere. We know these rating agencies, they seem to have not really they seem to go very hard on developing countries. They're not really looking at what other countries are doing, mostly the developed world. I'll probably do another video to show that. But anyway, there will be some rating agency concerns as well. They'll raise that one. So the prolonged trade wars, it will slow the economic growth for America, and it will increase inflation. And this could also lead to credit rating pressure on US debt, which that one I doubt that will occur, but probably may occur when these bond markets become an issue that is obvious for everyone to see. They'll be forced to actually act their credit rating agency to maybe give them non-investment status or something like that. Those agencies are like Moody and Finch. Anyway, so the implication is a downgrade. Will also rattle some of the global markets. Some of us here in Australia and the rest of the global market will be actually affected. Let me put it bluntly. We're all going to be affected anyway. And this also will further also raise the US interest cost when you got a credit agency concerns being raised and being downgraded from, star, triple A, B, whatever, non-investment options that also increase the debt. Okay. If that were to happen, then what's the next? What would occur? What would occur then next? What would be the next option would be that there will be a safe haven shift away from the US dollar. And we've seen that over this tariff period now. We saw how the, money moved from US dollar to UN. If you weren't paying attention to the stock markets, that's what made Donald Trump to stop the tariff. To go on and on with this stuff was that, there was a very profound risk, and that risk is also continuing even today. I'll show you some chart about where the 10-year yield bond is sitting and the 30-year yield bond is sitting. So that also suggests to me that this is not over yet. So these tariffs that have been posed for 90 days, the investor knows it's like sitting there with a grenade with the pin open. They know it's coming. So it's not really making everyone easy here. And this is not making everyone really feeling like, okay, we're okay now, we can relax now. It has created a huge uncertainty. So uncertainty is not something you want in business environment. There's no uncertainty. It's something that it's a big problem for investment purposes and also for financial market. So the US dollar is usually, as we know, it's a safe haven for many countries, and the US Treasuries are also central to that. That's why people, put and hold the assets in US dollars, and they prefer that because it's been seen as a stable, not as volatile as other markets. But if now the US dollar has been seen as a very political volatile, or as actually economic reckless. It's actually reckless at the moment. The view is that US dollar, it is reckless. The US itself, it's reckless, economic reckless, and it's playing around with people's money. So because there's a perception that's growing around the financial market and investors that the US is playing around with, people's money. And so you can see that diversification. The investors now diversifying their risk and pulling all them cash out and buying safe assets like gold, the euro. We see a rise in euro and yuan as well, and Swiss francs. We saw that as well. That was what the investor were doing all this time. When Donald Trump was busy and saying, they're doing the ripping, they're ripping you Americans. They're not ripping anybody. The most people are going to affect it first and foremost are going to be Americans. But we're also going to be affected here in Australia. Yeah, I went to Costco today. You know what? When I got there, I went to the egg section. There was a restriction on eggs. Would you believe Costco in South Australia has a restriction on eggs? You know, I've been seeing online everywhere people saying, "Oh, my eggs! Oh, we can't find eggs. Eggs are so expensive in America." People, I thought, oh, didn't worry about it. Then went to Costco today. I was like, wait a minute. Now, it actually felt like a COVID again. You know, the lockdown. The feeling of this tariff feels like a lockdown. I don't know if you guys, give me your thoughts about it. The whole tariff thing feel like a lockdown. It's like you like kind of like have a relieve the trauma of the lockdown. Like, oh, so now I walked to Costco. I was like, there's a restriction on eggs. So immediately, my brain just went back to the COVID lockdown. Straight away, it took me back. I was like, what's going on here? And I start thinking, yeah, it definitely is. This thing is going to really disrupt the supply chain. Like I said, most of these plants in America, these tags, things they produce, they rely on those small parts from China. So how are they going to manage that? I don't know, but we know that Apple has already had a plan. You know what Apple did? They flew all their iPhones from China by first class. First class, they all flew to America. So they by the time the tariff starts, all in America. Yeah, yeah, gotta laugh at it, isn't it? Yes. So let me get back to it. Okay, let me not be overexcited about this thing. Yeah, yeah. So the safe haven shift of away from the US dollar, we spoke about that. So this also the weakens the treasury as well, and also may undermine the US bond markets and its being a global dominance in that sector. Okay, so yes, I think I got a bit of a question. Yeah, about the bonds. The bond is just it's issued by the government. So usually the government issues certain bonds. When they, for example, if they want to build a bridge or something, they'll issue some bonds, and people will buy. It's a debt. So you loan the money to the government to do that, and then at a fixed interest rate. Okay, so they kind of give you a return. People can still do it for short term anyway as well, to trade that for short term. In summary, the Trump escalation could actually drive up the bond yields. They could increase inflation expectation. They could also trigger sell-off, especially by China and other countries like Japan. Notable, Japan did pull the pin. And it could also raise the borrowing costs, the US borrowing cost for their debt, to service the debt they have. It could also undermine, very important one, undermine US Treasury as a global safe haven. And we can see that undermining of this. Like I said, these tariffs, they're the form of extortion. I mean, I don't blame China for not engaging with that. Who would want to engage in this stuff? I mean, even the very formula they used, the number of fudge, they put the wrong numbers, while the correct numbers should have been put there to actually give about a correct mathematics, but they failed to do that. And they fudged up the calculation. The calculation itself is not measuring that. They just put that phi and epsilon to look a bit smarter, but really, because that research paper we're telling them if they're going to put tariffs of any kind, they're actually the phi, which is the pass-through rate of that tariff, it's actually 1. It's not nearly to 1, so because 0.8 we convert to 1, it's just 1. So that's 1. So if it's a tariff of 145%, it's 145% to the consumer. Business, anything tariff you put in, it's the cost of doing business for a importer. So they're going to pass it on. I mean, being, just give you like a very sort of an understanding that, being rich doesn't really gives you it doesn't make you smarter. You can be wealthy and still be an idiot, can really look a bit, you're wealthy, but you are very much an idiot. And this is what we're seeing, sitting around with the billionaire, Trump sitting around with his billionaire mates. They messed this one up big time anyway. It's, very scary for everyone involved. But, he made a lot of money. Their friends got richer because people who were scared, your mom and dad, who were going to retire soon, they saw the stock market going down. They pull out the money. And obviously those billionaires bought their stock, their position, and they got themselves richer. There were people on that day when they had their rally in the US stock that moved from being a millionaire to billionaire status just on one day in the US. So that also is as well, it's actually very dodgy, and it's US now has been seen as very unstable market. It's a market that you can't trust, markets that can be manipulated. So that's not something you want. It's going to be really hard. This is how you make America great. You make it that way. I don't know whether you make it great or you make it dumber. You decide.